So you're looking to build a truly stable passive income stream right here in Canada? Well, you have definitely come to the right place. In this explainer, we are breaking down two really clear blueprints designed to get you that first passive paycheck month after month.
Does this sound familiar? I mean, you've put in the hours, you've worked hard, but you're just stuck in that endless cycle of trading your precious time for money. You just know there's got to be a better way to build real wealth and freedom. Well, that is exactly what we're going to tackle today. How to stop trading your time and start making your money work for you.
All right, just a quick but really important heads up before we dive in. Everything we're talking about today is for educational purposes. It's all based on the team's original research and a ton of experience, but it is not financial advice. Please make sure you talk with a qualified professional to get guidance that's tailored for you.
So let's talk about this trap for a second. It's that feeling, that your financial growth is handcuffed to the number of hours you can physically work. Breaking free from that means finding a stable way to generate income that doesn't need you to be there all the time. And that, my friends, is where a smart, well-structured portfolio comes into play.
Okay, let's get to the good stuff, the solution. We're going to walk through two very distinct portfolio models. I want you to think of these as paycheck blueprints. They're tangible, real plans for generating that consistent monthly income, and they're designed specifically for us Canadian investors.
First up, we've got the high-yield starter. So this blueprint, it takes an initial investment of about $10,000 and turns it into over $100 a month. Now, the trade-off here is that to get that higher yield, you're accepting a bit more volatility, mainly because the portfolio leans a little heavier into some growth-oriented assets. Okay, next up is the stability-focused plan. This one's a bigger play, right? It's about a $50,000 investment, but it kicks off over $400 a month. That's enough to cover a car payment or maybe your condo fees. So in exchange for a slightly lower percentage yield, this portfolio is built for more stability, putting more weight on less volatile assets like preferred shares. And this slide, this really lays out that classic investment trade-off, doesn't it? With Paycheck 1, you're going for a higher percentage return, but that comes with more ups and downs. With Paycheck 2, you're prioritizing stability and a bigger paycheck in your pocket each month, which means a lower percentage yield. And look, neither one is right or wrong. It just depends on your starting capital and what you're trying to achieve.
All right, let's cover some really practical points here. First off, all the funds in these blueprints are in Canadian dollars. That means you don't have to worry about currency exchange. Huge plus. The dividends, they get paid out every single month, usually in that first week. And here's a super important reminder. That yield percentage you see is just a snapshot in time. It is not a guaranteed interest rate. It's going to move around with the dividend and the ETF's price.
So now that we get the big picture of the blueprints, let's zoom in and look at the actual building blocks, the 5 ETFs that make these portfolios tick. First, you've got HDIV. This is really a core holding. It gives you broad diversification across the absolute best-in-class Canadian and U.S. companies. It gives the whole portfolio a really solid multi-sector foundation.
Next up is HIIS. Now, this ETF is all about the Magnificent Seven, the biggest U.S. tech giants, plus some other digital assets. This is the engine that really drives the higher yield, but you gotta know it is also the most volatile piece of the puzzle in these portfolios. Then we have Bank. Pretty straightforward. This one gives you exposure to the Canadian financial sector. It's an absolute cornerstone of the Canadian economy, known for its stability and, of course, those consistent dividends. Next is RPF, which is all about Canadian preferred shares. Now, you can think of these as kind of a hybrid between stocks and bonds, and they offer fixed dividends. This makes RPF a really key component for stability. It's like a defensive anchor holding things down in the portfolio. And finally, there's HHL. This fund is focused on the healthcare sector. Healthcare is what we often call a defensive play, simply because demand for it stays pretty consistent no matter what the economy is doing. It just adds another layer of resilience. So we've seen the what, right? The specific ETFs. But honestly, what's way more important is the how, the actual philosophy behind putting them all together. Let's dig into the core principles that guide the team's entire strategy. Okay, so the team's philosophy is really built on a few key pillars. First and foremost, protect your initial investment. That's job number one. Second, aim for growth, but with resilience baked right in so you can handle market downturns. This means focusing on risk-adjusted returns, not just chasing the biggest numbers. It also means avoiding what we call worsification, which is when you diversify so much that your returns get watered down to almost nothing. So here's the crucial point, and if you take one thing away, let it be this.
The magic isn't in finding some secret magic ETF. It's about building a balanced structure where every single piece has a specific job to do. How those pieces fit together is so much more important than any single piece on its own.
And this brings us to a really key concept: total return. This is the true measure of how you're doing. Why? Because it combines the income you get from dividends with the capital growth you get from the ETF's price going up. I mean, think about it. High yield is totally useless if the value of your initial investment is shrinking. A healthy total return, that's the real goal.
At the end of the day, success really just boils down to two things. First is consistency. You have to stay invested through the good times and the bad. Trying to time the market is a fool's errand. And second is conviction. You need to truly understand what you own and why you own it. Do your own research so you can invest with confidence, not just because you're following a trend.
All right, let's bring this all home. We've talked about the problem, the blueprints, the individual parts, and the philosophy behind it all. This is about you taking control and actively building your own financial future.
So here's your path forward in 4 simple steps. First, recognize that you want out of that time for money trap. Second, really understand the trade-offs we talked about between yield and stability in these blueprints. Third, apply those core principles of portfolio structure and protecting your capital. And fourth, always focus on the total return.
And it's really important to remember these are starter blueprints. They are powerful ways to get in the game. But for those of you with more capital, or maybe you're just looking for more advanced strategies, the team covers all of that in their detailed 2026 model portfolio research.
Today, we've given you 2 clear, actionable blueprints. Think of it as the starting line for your passive income journey. The only choice is figuring out which one fits your situation right now. And that really brings us to the final thought. The path to your very first passive paycheck is right here in front of you. It all starts with a single decision. So the real question is, what will that new income stream build for you?